Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Kevin Kim, partner at Fortra Law. He's a securities attorney specializing in fund formation and mortgage fund advisory. Kevin was a guest on this podcast in 2025, and I always like having him and his partners on our show because they have such a unique insight into what's happening in private lending, and they're so generous with sharing that knowledge with our audience. In this conversation, we talked about some of the trends that Kevin's seeing with his clients who are primarily balance sheet lenders that manage a mortgage fund. We spent a bunch of time talking about how private lenders that operate a mortgage fund can stay out of trouble, and this was triggered by the unfortunate collapse of Pacific Private Money, which is a lender in the San Francisco Bay Area that has been around for quite some time and operated multiple private mortgage funds. We finished off talking about Fortra Law's 2 annual conferences for the private lending industry, one of which is happening at the end of March in Las Vegas, and their other one is in Newport Beach in late August. I hope you find this episode to be insightful. Here's my conversation with Kevin Kim. All right, Kevin, thanks for joining me for this episode of Private Lending Insights. How's everything at Fortra Law and everything with Kevin Kim?
All things good. All things good. We're busy. The market is in a weird place. So, we are so entrenched in private lending that when the market has any headwinds, we're being pulled in to help. And so that's been fun to watch, but also stressful. We want to see our clients thrive. So they're facing some challenges. Personally, everything, couldn't ask for more. Thank God, everything's great. I'm healthy. My kids are growing. So, fantastic times over here.
Well, let's talk about some of those challenges that some of your clients are seeing. What exactly is happening in the market right now?
Well, it's kind of a weird time on the default side. I feel like defaults are up. Some are getting it worse than others. Texas is feeling, at least Western markets, Texas is feeling the brunt of it. And I think that has to do with all the volatility in real estate values. Clients are really getting, I guess clients are struggling trying to keep up with the competitive landscape. The market has changed a lot past 3 years. So with how competitive is out there, many lenders are finding themselves having to say no to a lot of deals or finding a way to get to yes and get uncomfortable in their business model. That's been kind of hard to watch, and they're trying to figure things out. It's like, let's do it together. And that's been the challenge. On the positive side is more and more clients are expanding their footprints. DSCR is a mainstay, I think, and so a lot of clients are really doubling down in that from an origination standpoint. But it requires them to, if you're just doing loans in 1 or 2 states, it's not going to be enough usually. So we're seeing an expansion in different marketplaces for that. But yeah, the default rate, it's starting to cause some stress, and the increased amount of leverage lenders are giving, I think it causes it to some degree, but and having clients having to face that challenge head on it's always a challenge, and I'm not doing the foreclosure work, but we're navigating the strategies with the business and the investors and all that kind of stuff, right? So
interesting. And it seems like in the past several years, defaults have really not even been much of a topic. It's just been so low for so many lenders for so long. What are some of the challenges now? Is that because values are dropping in certain markets?
Texas is primarily driven, it seems like, at least, from value concern. The local markets in like this, Austin, San Antonio, which is like kind of the hub of Texas private lending, that values just tanked, right? Home values just tanked 25%. So, you're underwater basically if you're doing anything above 75, right, on LTV. It's not so bad here in California, although defaults are up in California, but it's not like, oh my God, we're busier than we should be on foreclosure, but it's not terribly concerning. So I don't know if there's a cause for it. I would just say that, I think it's a product of also people pushing more leverage, right? And that's just a matter of how much capital there is, supply demand, right? They're going to push more risk and more leverage, and the institutions, they can manage that risk. But the smaller guys, they're having to manage it themselves, and it stings a lot more when it's your money, right? So
Totally. And with Texas in particular, it's probably the easiest state to foreclose in. With some of these defaults, are most of your clients trying to work out the situation with the borrower, or are there foreclosures happening and the lenders are taking back these properties?
yeah, taking back the properties typically, and it's just the values aren't there anymore, right? So the longer days on market, the property is not moving, requires a good amount of capital to invest in. So that's been a pain point. We haven't seen the same phenomena in like other, I guess you can call them up and coming markets of the past 5 years. You and I have been around long enough to know like Texas has been the darling for a long time, but Arizona also became quite popular, and we're not seeing the same phenomenon in Arizona or even in Washington. I think Texas is a unique situation. Florida has the same problems as well, but yeah, we're not seeing a lot of like, I would say, workouts, I guess. I mean, the idea here is that the sponsor typically taking back the property and figuring out what to do with it, or they'll offload it up. They'll offload it and find a distressed debt buyer or something like that. But yeah, I think that's been one factor that's been causing some challenges for clients, for lenders, and then overall just how competitive it is out there. Many lenders are saying it's brutal out there, and they're saying the challenges on origination have been more and more stark as the national shops, the institutional shops, are able to present a product that they just can't compete with. So
And speaking of that, I finished listening to your latest episode for your podcast, Lender Lounge with Kevin Kim, where you interviewed the two founders or two principals of Rain City Capital, and that's an example. And it just keeps me. I keep thinking about this, and I've asked other people about this: is how are there enough potential loans out there for these lenders to fund so many, right? Where if you get these large national shops that are funding, $1 billion a year, $500 million a year, uh, and in a market like now, there's not, it's not like there's tons of foreclosures happening, where there's so many houses out there to flip. Supply is still an issue. So where are these deals coming from? And it seems like the bigger guys are just taking up most of the market share, and then the smaller lenders are not closing as many loans as years past.
that's what it feels like, right? That's the fascinating part, is like that's what the feelings are. But if you look at the market data, it's not bearing fruit. Like all the different, there's a lot of them now. So I think there's like 3 or 4 different like data platforms that aggregate industry data, and they're still sitting on about 20 to 30% market share. The top like 10%, top 10 ranking lenders. So it's very watch this goes to something someone said along. I think Eric Abramovich said this on a panel one time. Like the vast majority, actually correct me as I'm corrected. It's John Beecham. John Beecham said this when I interviewed him. The vast majority of these deals are still being done under the table, right? And we're starting to see a little bit of this with all this wholesaling that's happening nowadays, and you see it there. And so, it's still a very weird market in that respect. Like finding deals in our industry I don't know. I agree that there's probably a finite amount of opportunity, but that also goes to the point that you see a trend on the RTL side. People are really gravitating toward construction loans, right? And so that's where the opportunity seems to be, because there's aging inventory is hard to get your hands on, because wholesalers, how competitive is out there. Whereas spec home builders and new development seems to be picking up in volume, at least. And so yeah, that's where at least most of our clients are finding themselves, and the rest of them are just saying, listen, we're going to have to play ball with how competitive it is, how institutionalized things have gotten. And I'm starting to feel like we're heading into the world of mortgage banking, and it's making me a little bit nervous.
Definitely. And so last year, it seems like the major concern for most lenders was fraud from the borrowers. Do you still see that this year, or do you think it shifted and lenders have figured out a way to mitigate that?
Yeah, I think the lessons were learned really quickly. The beautiful part about our industry is like when something happens that dramatic, word spreads really fast. And and at the institutional level, the TPR shops, they jump on it really fast, right? So that's really good from our industry. We react pretty quickly. With all the big scandals, right? Everyone talks about the Baltimore scandal and the Florida scandal. I'm like, I get that, but that's really more of a vendor management issue than anything else, right? And so like when it comes to vendor management, I think a lot of folks, and an underwriting issue, right? So I think a lot of folks have really took a second look at their operations, and all things being equal now with all these new FinCEN rules coming out and going permanent, like I think the rules are going to make these new rules are going to make lenders really pay attention to doing all the right necessary steps. Know your borrower, you have to do it, right? Getting all that data on the borrower, identification, do an OFAC check, but also like making sure that you're not part of any kind of weird potential fraudulent schemes, right? So because now if you don't, well, FinCEN's supposed to hear about this, right? So that's one of those things where I think I don't love that kind of regulation, but by virtue of it happening, I think it's overall everyone's gonna get in a better position from that perspective. And I don't think it's really anyone's fault per se. They just really tried to do their business as well as they could. But that goes to like when you're overly competitive, you make cut corners, and that's where mistakes get made, right? And this happened to be a big mistake. I think people learn pretty fast. Now I'm more worried about like really strange angles for fraud out there. There's a lot of random schemes out there that we have to be very cognizant of. If you're more of an aggregator type or you're buying loans, you really have to be careful about, making sure those assignments are, properly done, and, you're not being defrauded by your originator. If you're an originator, you got to really make sure that your borrowers are bringing you the full story, and you're doing all your KYC, and you're monitoring the use of proceeds. And there's a lot of, funny business going on out there. So it's important, but I think our industry moves pretty fast. So that's what I like about our industries. We're fast paced, and people learn their lessons pretty quickly.
Yeah, and so fraud seems to a lot of lenders are aware of it now, and they're able to catch a lot of them. There's, like you said, there's defaults are an issue now. Are there any other concerns that lenders have, or things that keep them up at night for 2026?
I mean, the running gag right now is we really need to put out positions that we're not the same as private credit, right? Like, because now with the whole BlackRock and Blue Owl scandal, with their redemptions and their funds, me as a fund attorney, like I'm talking to clients, they're trying to figure out how to make sure their investors don't go running for the hills, because it's not the same kind of lending, right? And so that's been a point of concern for a lot of people. Lenders who are balanced lenders are watching different funds, because a lot of their investors are invested across different funds, whether it be the big public funds or private funds. And so they're really cognizant of like, oh man, one bad apple can ruin the bunch. Or, if they're worried about that, are they going to come over here and start venting their concerns and that kind of stuff? So, but at the same time, like in our industry, we're not making business loans, right? We're making real estate loans. And so the investors need to really understand, like, we are not the same thing as those guys that call themselves private credit. We are real estate finance, and it's completely different. And so, it's hard to justify that when you're just when all your marketing stuff in the past would just said private credit, right? So, but I think that most of our clients are pretty smart when it comes to making sure they educate their investors and their borrowers. And so, I don't see a lot of risk coming out of that, a lot of exposure coming out of that. Just an extra thing to work on,
Yeah, it seems like a lot of fund managers have embraced the term private credit in the last 5 to 6 years. And
Yeah.
but
It
I mean,
was so sexy, man. It was like there was so much capital flooding into private credit, like
and maybe it is still justly classified as private credit, but that's such a broad term. I mean, even any investor within private credit understands that there's the majority of the private credit, as I understand, is corporate debt, right? It's really big or mid-sized to large corporations that are getting debt from private equity firms. Then you have the small business finance stuff that could get securitized. Then you've got our industry, which is real estate
Mhm.
primarily mortgage funds, but also
And those guys don't have collateral if you think about it. All they really have is like, business assets, maybe some receivables, but really not a lot of collateral. We have hard collateral. So ultimately, and then from a risk standpoint wise, I mean, just you know, they have to justify debt service coverage through a bunch of cash flow equivalents. We're looking at value, right? And so there are risks that we have, but you can't equate the two. They're completely different.
yeah. And one situation that's been on my mind the last few weeks that I was really sad to hear about is the collapse of Pacific Private Money,
Yeah.
which has been a long running private mortgage fund based in Marin County, California. That
Series of funds. Mark had a bunch of funds. Yeah. Yeah.
Yeah,
Yeah.
yeah, and so I don't know much about that situation. There's been one or two news articles about it in the public.
hmm
But what are your thoughts about what you've heard about that situation in general?
Well, this is kind of one of those things where product of legacy, so like, legacy operators that never really invested in infrastructure when it comes to their funds, right? Like funds require its own infrastructure, right? And so the beautiful part about our industry, like I said before, like it moves so fast, people learn so fast, and our industry has grown up so much, and so has the fund side of things, right? What once was, you just kind of had one, and you ran your accounting through some kind of software, and you kind of just did things loosey goosey. That was the old ways, right? This is kind of like post recession type strategy. And over the years, as people, I guess, as our industry matured, people started to mature with it, and their business approach started to mature with it. So you see a lot more sophistication in the operations, more resources being driven to operate these funds, both from a vendor standpoint, but also from a legal and back office and all this stuff, right? And I don't know that there was that level of discipline over there. I haven't spoken with Mark in a while on his strategy, but other things that can be cause for concern. This is not commenting directly as to Pacific Private Money, but really in general in our industry, when you see funds end up in this situation, it's a product of really kind of, you see the sponsor. It's very sponsor driven, and he's really trying to. He's thinking in his head. He's trying to fix a problem, but what he's really doing is making it worse, right? And so, and the question is like, yeah, I'm doing this, and they rationalize it that way, right? And so, what's concerning about that is, well, there's a right and a wrong way to do things, right? And so, just because you're doing it because you think it's beneficial for the fund or for its investors, it may not be the case, right? And so you see that a lot with multiple fund situations where assets are being moved around they shouldn't be, or loans are being done in a weird way, and they're transacting with each other without the right disclosures. And ultimately, it's a they forget what's a material fact, and that's really important, right? Investors need to know if you're going to be transacting with an affiliate to the fund, they need to know, right? It's a disclosure item. Are you lending to yourself or an affiliate? Well, that's a disclosure item. Are you buy or selling assets to an affiliate? That's a disclosure item, right? 'Cause if it was your money, wouldn't you want to know that, right? That kind of thing, right? So these situations, and it very rarely comes out of a place of like, oh, I'm gonna screw these guys over. It's not like that. It's typically from a place of a problem occurs, and the sponsor, being an entrepreneurial spirit, is going to try to fix a problem. And they run their fund docs through nowadays they run it through an AI. It's written broadly, so they think they can do a lot of stuff. What's written and what you should do are two different things, right? And so it's very important to think about, when you run into a crisis. Yeah, you got the idea of digging yourself out of a hole. It's typically not the answer, right? And so that's where I think a lot of folks go wrong. And what ends up happening is that, and this is not direct, I have no direct knowledge as to what Mark did here, but like I see a pattern in a lot of these cases where the sponsor is not completely forthright with what's going on in the portfolio. They're not lying, but they're omitting facts, right? And so what a lot of times sponsors forget is under the securities regs, it's not just misrepresentation of material fact, aka lying, but it's also the omission of material fact, right? The intentional omission, failing to state, right? So you are required to disclose, not just tell the truth, but also to disclose those items. And that's where things get a little bit hairy because people forget that they have to do that.
Pacific Private Money been around for a long time. In fact, they were one of the first private lending companies I did business with when I started Private Lender Link, and this was back in 2012. The fund manager that Kevin's referring to is Mark Hanf, who I always thought was a good guy and had a good experience doing business with him. So when I first started working with him, this was before he had started a fund, and it was, his capital was trusteed investors, and he grew quite fast. He was really good at marketing, and then he launched the Pacific Private Money Fund, and that seemed to have been successful. But what Kevin was mentioning is that he had started a few other funds that had different strategies and different strategies in terms of origination, and then there was one that was more geared towards selling loans to the secondary market, as far as I know. So there were just multiple funds that were being operated, and Kevin, that's what you were referring to, right? Where you're when you mentioned the multiple funds earlier.
Yeah, and so multiple fund. Whenever a sponsor has multiple funds, the important thing is like you have to disclose are they going to be completely separate, or are they going to interact together? And if they are going to interact together, let's make sure we disclose it, right? Because that's a material fact. Otherwise, you could be accused of commingling, right? So you don't want to do that, and you're getting paid on both too, so you really should be very transparent about those issues. There's other issues that come out of this fact pattern, and a lot of this is not public knowledge, but like. In this particular case, the challenging issue seems to be that there was also a product of like just increased really negative situations in the portfolio itself, right? And so making bad loans, right? And so, and when it comes to losses in a portfolio, it's almost like it's a snowball effect, right? Because if you start seeing losses, your inclination is to make sure that you prevent exits from the fund. But if you don't do that in a very well thought out manner, it can lead to more stress because the investors are now going to riot, and they're going to, saber rattle with lawyers, and they're going to call the regulator, and then the regulator is going to come looking. And, and what people don't know is state regulators are actually the first place they start with. And those regulators, they get a complaint with enough words in it, they're going to start sniffing around, right? So from my perspective, it's almost easier to it's almost easier to not necessarily pull that ripcord out, even though you may think it's an emergency, and really have that sounding board network, right? And I encourage people, like, it's not just someone like me, it's also someone like, for example, a colleague in the field, a vendor, maybe an accountant, like just idea. Think about the best way to go about this, because what I've noticed in crisis management is, if you're too oblique about things and you're just like, this is how it's going to be, and you just kind of do it that way, investors react in you can't predict how investors are going to react. And so if your investor relations game is not well thought out, and you don't have the disclosures to back all this up, they're going to lose their minds. And then if you're open-ended, what's even worse about this is that if you raise money into a fund knowing you had losses coming, well, now we've got a bigger problem because you omitted that information from this guy who's coming in, right? So he's going to face a loss right away. So these investor relations issues come with, not just, I would say it's not really a legal thing, but it is. Your docs say one thing, but that's not the end all be all, right? You really should think about what's the best practice in here from a investor psychology standpoint. And I don't love the, I call it oblique, but like the more like kind of like you shall not pass kind of approach, I don't like it. I think it creates more problems in the long term.
Most mortgage funds have annual audits. You get a third party accounting firm that does an audit of a fund. I wasn't too familiar with the Pacific Private Money Fund in the last 5+ years, but news report says that it was around $100 million. When you have that much under management, obviously you're having annual audits done, but
Well, it's a question mark. Yeah, I'll tell you, this goes to kind of the legacy, right? The market's changed, right? Like a lot of the older funds, they've gotten, they what once was okay not to do audit because you were small, right? Markets was small. It legally speaking, not necessarily required. Like it's one of those things. Like okay, and also it's a matter of being cheap, right? Like I don't want to do it. It's expensive, and you'd be surprised how cheap our industry can get, and so people will use that excuse and not do it, right? But today, for us here at Fortra, we tell folks whenever we do a fund, table stakes these days is audited financial, third party admin, and it's not because of the law. It's because this will put you in the best position to submit to legitimacy, right? You will be able to demonstrate you are a legitimate outfit with third party vendors that are auditing you and will doing your accounting at all times. And yeah, it costs money. I get that, right? But this is kind of one of those things where like, okay, let's look at all the top performers in the fund world. They all have these things in our world, in our industry. They all have it, right? At least audited financials, right? I don't care whether the law requires it or not. They have it, right? So that's one of those things where like that's where our industry has grown up in a lot of ways. And so if a client tells me they don't want to do it, I'll tell them, hey, it's best practice. It's recommended. I recommend it, but it's your call to make, right? But the law does not necessarily require it. It only requires it if you've got non-accrediteds, right?
non-accredited investors, you mean? But
Yeah.
as an investor, I mean, I always think about this when I hear about fund managers that don't want to pay for an audit because of the expense. I mean, that must make it hard to raise capital. I mean, if I was a fund investor, I mean, I'd look at a fund saying, "Oh, we don't have audited financials." Why the hell would I want to take that risk and invest with a fund that doesn't have any
Yeah.
sort of accounting oversight? That's insane to me.
Well, that's where like, there's always this like kind of fund manager that relies on what I call cult of personality, right? And they're not as concerned about the fundamentals. And there's a lot of those out there, and a lot of them don't have audited financials. And I agree with you. Like I wouldn't personally, right? And I do this for a living, right? And so I don't care how good the sponsor is. Yeah, like you said, like if they're so cheap they can't even pay for audited financials, like come on, right? Like it errs to poor, like not legitimate. Second, I think that it's also like it's to me it's table stakes. Like it's every single fund out there that's made it, they all do it, right? And sure, it's expensive, but don't I, the investor, deserve that? That's how I look at it,
Yeah, and even if let's say a fund does have annual audits, whatever situation that could cause a fund to collapse or take on losses, that technically could happen within the 12-month period of the next annual audit, right? How do investors?
That's another thing. Like a lot of folks think that like losses are a 4-letter word, right? And it's like I get that, or it's like sign of the oblivion or the apocalypse. Like no, hold on. Like first of all, if your investors are unaware that a loan can take a loss because the foreclosure happens and the property tanks in value or whatever, right? They may not be the right investor for you, right? If you're thinking that a loss on a loan is the end of the world, I'm sorry to tell you, the law of large numbers tells you that you are going to have one. It's going to happen, right? It's a question of how you manage it, right? And so how you manage investor expectations, how you manage reporting, how you manage the communications. I found that investors are typically remarkably forgiving as long as they understand that you have a plan and you have a very well thought out one and it's been disclosed and you follow best practices. They typically are very forgiving. Where I do find problems to arise is sponsors hide the ball, right? And they hide the ball by trying to cover it up, right? I'm gonna cover this up. I'm gonna figure out a way out of this, dig myself out of this hole, right? It never works out.
And this situation with Pacific Private Money is still, I mean, there's still ongoing investigations. We still don't have a ton of information about it, but just the collapse of a fund in our industry. Have you seen several other cases like this?
Yeah, over my years, I've seen a few times happen. Very rarely is it because of the portfolio, right? Almost never, right? It's usually sponsor driven, bad choices, kind of what we call running from the law, right? Not being forthright and getting in front of it with the regulators. Because regulators are typically not trying to like like they don't want to bring down an indictment, right? They're not usually interested in doing that because like as I worked for when I worked for the commission on the enforcement desk, I remember all the attorneys would complain about the fact that like DOJ is coming and taking our case away from us. They don't like it, right? They would rather just resolve the case through a civil settlement, right? So, but it's good for their careers too. So, it's a question of how it's sponsor driven, right? Like you have to really think about how you're going to approach this. I think the other issue that we find in cases with fraud, with funds, is the sponsor takes way too many liberties with the business, right? And so, I mean, extreme cases, right? So you have extreme cases where outright securities fraud happens, right? So and that's still liberties, right? It's not a Ponzi scheme per se, but like it was never disclosed that this fund could go out and buy marketable securities, right? But the fund managers did it anyway, right? Like, okay, well, that's not allowed in the document set, first of all. Second of all, you shouldn't have done that with all the necessary compliance in place. So that kind of stuff has been, and then that leads to an investigation. And then if the sponsor doesn't get in front of it and try to solve it, they could end up in a situation where not only are they being, sued into oblivion by their investors, sued by the regulator civilly, and then eventually DOJ, right? So, and we've seen it, right? There are folks in our industry that are serving time now, right? So that were in our industry are now serving time, right? So there are other situations where it's more sponsor driven, but like really bad ideas in their marketing, where they're equating it to certain types of investments that are just no, like you would never do that. It's like almost common sense failures, but I don't know where it comes from. Where they equate it to like, I don't know, like a CD or like a 401k pension driven strategy or something like that. Yeah, but the majority of these cases typically revolve around investors losing their minds and calling the regulator because the sponsor is facing headwinds in the portfolio, did some bad stuff. Now the investors are locked down and they don't know what to do, right? And so, I've been there a lot, but in cases that I've dealt with, it almost never leads to a regulator because we're getting in front of it early, right? And so we're shutting the investor down. We're resolving it with him as fast as we humanly can to make sure that the regulators are going to stay off our backs because we're trying to avoid that as fast as possible.
And any fund manager out there that wants to be more transparent with potential investors, I mean, what else can they do to show that hey, our books are clean? Besides an annual audit, is there anything else that they can?
Yeah, and this is where I think that I'm working on a piece on this right now, right? So, what I would consider best practice from investor, I guess, transparency standpoint: A, audited financials; B, periodic reports, right? So usually quarterly reports, right? And this is not the investor statement, right? The investors are going to get a monthly or quarterly statement about their account, right? That's different. A report, right? And say, hey, this is what's going on in the portfolio. This is going on in the market. This is what's going on. Here's a data sheet about what our portfolio is comprised of. Here's what our default rate is. Here's what our plan to address that is. Here are the headwinds the fund is facing. Here are the wins the fund is facing. The fund is being able to achieve. That kind of report is pretty much a standard practice in public markets. And so if you're not doing it, your investors are basically on an island, right? And there are funds, I would call them, they've been around forever. They do that perfectly, right? Newsletters go out, all that information, financials go out every year. And then they even go so far as to do like webinars with their investors to educate them what's going on. And then they also have, kind of a hotline, right? And it's like, investor has questions, call. Like, we'll happily walk you through stuff and teach you stuff, right? So that's a pretty common practice today. But a lot of times sponsors get busy, and so they haven't built the process around that. I strongly encourage that they do. We consult on that. That's the thing with us. We'll consult with that after the fund is launched, and that's kind of part of the usual package with us.
If a fund manager puts out a quarterly report, that's internally they're generating that report. How do you get third-party verification on their accounting, their books, to see if money's been moved around? Is there anything like that?
Yeah. And this is a big issue. Yeah, for sure. On the accounting side, this is why I love the idea of third-party fund admin today. It didn't used to be necessary, until this tax rule change. Funds in our world were just done operating company accounting. You didn't really need it. You just you just do that, and it was actually pretty easy to do, right? Today, investment company accounting is the standard. It's not followed by everybody, right? But it is the standard. And so to do that correctly, you really need to be an expert. And so I think today, third-party fund admin is pretty much also, I consider it to be table stakes. It's quite competitive in that landscape, so you can get a good deal from all the different vendors out there. Obviously, you get what you pay for, so that the really cheap ones are gonna not be that great, right? But at least you have a licensed CPA, basically firm, doing this for you and monitoring your accounting, doing your P&L, making sure the distributions are correct. That's huge. Making sure your fees correctly accounted for. And this has been an issue where like I've seen it come up in regulator actions, because if you incorrectly calculate things, you could end up with like not over distributing or under distributing, right? And so over distributing could lead to a loss. Under distributing means you didn't pay them enough, and they expected to get certain dollars and they didn't, right? So pretty important.
Yeah. And with the fund admin, so that's done on a monthly basis, right? You have a fund admin company that reconciles the books on a monthly basis, and then they generate a report, and then the fund manager then gives that report to the investors. Is that how it works?
Well, it's not a report, right? So the thing of the third-party fund administrator to basically be replace a controller in a business, right? This company is going to do a number of things. They're going to maintain the P&L. They're going to monitor expenses. They're going to make sure that the distributions are calculated correctly on a timely basis. They're going to make sure your fees are charged correctly. There's no report that they produce per se. That leads to the statements, right? And then that leads to the financials and tax returns. But you have a third-party professional doing the actual funds bookkeeping and accounting on the day-to-day. And then they're also helping the accountants do the K-1 and the audit, right? So that responsibility is so important because it has to be done correctly. And so investors really appreciate it when there's a CPA running that as a third party, because they have their own duties and obligations under their license. So it's really, really useful.
Going back to this case with Pacific Private Money, having $100 billion fund that collapses, and you have tons of these investors who are going to incur huge losses with the funds they invested. Do you see that cases like this make the case for investors to go more towards the note investing vehicle instead of a fund? And that could be an argument that, hey, look, I don't want to invest in your mortgage fund because, I've heard the cases like this. I'd rather invest in a note individually or a trustee. Is there a potential risk of that happening at scale?
I want to say no, but it's not a self-serving no. Being fund counsel, it can obviously be taken as self-serving, but I still think, note investing is tricky, right? So if you're talking about like whole note, trust deed kind of investing, that opportunity is dwindling, right? And so with the market being what it is, if I'm a lender relying on trust deed, I'm probably going to start looking at the secondary market, unless I'm doing like seconds or weird commercial loans, right? And so the pickings become smaller from a trust deed investing standpoint. the other issue, and also you're directly exposed to the loan. I still think that's kind of scary. Um, on the flip side, on the fund side of things, it's just a question of picking the right horse. And so investors really need to ask themselves, am I picking the right horse? Right. And yeah, sure, there might be situations where these you may feel, that you're being taken advantage of by the sponsor if you're an investor. Well, that's a question of, okay, well, what's their investor relations team look like? Right? Are they actually a going concern business? Right? Are they taking this seriously? These are questions that you can, and it's also a question of character, right? So there's a personal component to it too, but like there's a lot of stuff that you can check the box on when it comes to like the back office side of things. Um, it's weird because investors in the fund world, their prereqs are almost irrelevant in my eyes, right? A lot of them have prereqs of like, oh, X number of years of track record. Okay, that's pretty relevant. No leverage, that's irrelevant, right? Leverage is not a bad thing if done right. They have to be doing certain kinds of loans only. Like, okay, well, that's not a good idea because what if the market changes? Like sometimes they say, I see like they must have certain types of tools in place. Like I met an investor who will only look at things with a certain type of investor portal. I'm like, this isn't irrelevant, right? What's more relevant is like who's their auditor, right? Who's their third party fund administrator? No, I don't want to be self-serving. Who's their attorney? Who's their, what kind of loan, like what's their track record on the lending book, right? Like do they have a tape they can show me? What's their default rate? What's their default rate last year, right? How many funds do they have? Those are really important questions to ask, right? So if I get asked to diligence a fund and it's not a client, I get really in the weeds on that stuff, right? It's not about, leverage or not,
Yeah. And speaking of having multiple funds, it seems like this is common with fund managers is they have a fund, they might start another one. Obviously you get into cases where it could be that the fund that they've started, the second one that they've started is completely different in terms of what they're originating from the first one. But tell our audience, what do you see? What situations do you see that fund managers typically start a second, a third, or fourth fund?
I like that kind of setup, right? So I get a little bit nervous when if there's multiple funds and they all kind of share the same mandate, right? It doesn't make why would you do multiples there? What's the answer? They're both open-ended. Like, I don't understand, right? So generally, I prefer it when fund one is designed for, let's just call it vanilla RTL. Fund two is designed for, say, commercial real estate finance. Some clients even go so far as to do it geographically, which is kind of interesting, right? I don't have any opposition to that. Other clients will do it like, vanilla, standard performing loan, distress strategy. And that's becoming more and more common, right? What are we going to do with our distress, right? And that's a really good idea because distress can be profitable in the right structure. So, that's a good idea. A lot more opportunistic stuff, right? Like the high risk stuff, the high leverage stuff, like that's a good idea. But if they're the same kind of mandate, I just don't know why they would do that. Right? Unless there is a good reason to do it that way, like levered versus unlevered portfolio. That's a good reason, right? Because there are some investors that are still allergic to leverage. I understand that rationale. But yeah, there has to be a justifiable reason to separate the two. And very, very, like, if you're going to have them co-lend on a deal or transact with each other, you better disclose that. Yeah, it's important.
And I've heard of cases where there's fund managers that have their core fund has 100 plus investors. Then they start another one that has one or two very large investors, and it's not an opportunity that's available to the I guess smaller, with respect, smaller investors. Yeah.
Yeah, I advocate that all day long. That's a smart idea. Yeah, because the big investor is very rarely going to want to be commingled with the other LPs. They're typically going to want something different. The issue you run into there is allocation risk, right? Because if you don't disclose the allocation policy and you're not clear as to where the loans are going to go, you can be accused of breach of fiduciary duty, omitting material facts, just fraud. You can do all that kind of, again, those kind of hot waters. So be very transparent about how you're going to transact there. And if you're going to co-lend to these two vehicles, be very transparent with all the parties.
And switching to some of the newer funds that are starting these days, are there any new strategies or any new situations that are causing people to start funds? That's sort of a trend these days.
I would say the same reasons are still the major reasons, right? So I want to get leverage. Fund makes the most sense. I need to be able to be a direct lender. I want balance sheet discretionary. I don't like doing trusted anymore. Fund makes the most sense. Past kind of 5-ish, 10-ish years, I want to maximize profits on loan sale. Okay, fund makes the most sense there, right? Because leverage is going to be too expensive on repo. But over the past year or so, right, I would say distressed, right, is kind of a good reason right now. But we've been hearing a lot. And distressed, not necessarily in the context of complete NPL, non-performing loan strategy, where you're just like, it's almost like I'm going to foreclose on everybody and just own a bunch of real estate. I mean, we get some of those, right? But the vast majority of it is like, okay, there's a lot of room for weird transactions, bespoke transactions, reperforming distressed debt, lender of last resort kind of situations to be opportunistic here. That's a common thread right now.
What about the secondary market strategy, where they're just gonna have a fund so they can close the loans and then sell them, and that's the only strategy?
That's been around for a while now. Yeah, gestational. Yeah, so I want to maximize profits from loan sale, right? I think that's a good reason to go into a balance sheet model in our industry, and it's different from non-QM. Like a lot of folks, think that they can just kind of run off like a repo line, right? You could do that, but those are very expensive lines of credit, and they're very high risk because you've got to buy it down after 30 days, right? So usually a discretionary balance sheet layered on with some more conventional leverage is going to be more profitable in the long term. So that's a very, very common reason to do it now. The challenge there is, it's harder and harder for sponsors to justify that structure because every secondary market player now is offering a suite of services, right? And so they'll table fund you, they'll buy it, they'll lever you, I get that, right? But one of the things that's oftentimes forgotten is that, that they're not always going to be there, but you will be, and your borrowers are going to expect you to perform. So, or they're just going to go to the next lender down the street. So, yeah, that's a very good reason. But it's been around now for about 6 years, 7 years. It's kind of a pretty commonplace strategy. I like it a lot because it engineers a very, very healthy return for the investors and sponsor per se. So,
all right, with that, let's just take a quick break, and we'll be back in 1 minute. Support for this show comes from Forecasa, an amazing data platform for private lending and real estate investing. Private lenders, note buyers, capital providers, real estate investors use Forecasa in a variety of different ways. You can see which lenders have funded which loans. You could see which real estate investors have gotten funding or sold a property or purchased a property. You can see loan assignments to know where the loan was sold to after funding. Many people use Forecasa as a prospecting tool. I personally use it to vet lenders and for general market insights. It's become an essential part of our business, and I just wish I had access to it sooner. We publish some of Forecasa's data on privatelenderlink.com. When you do a search for lenders, you could see the top 20 lenders in each market, and we've also added the top real estate investors in each state and for some of the metro areas. Visit Forecasa.com to schedule a demo, and please mention that you heard about them from LenderLink and the Private Lending Insights podcast. And we're back with Kevin Kim, Fortra Law. So Kevin, you have a conference coming up at the end of this month. So tell us a little bit about the Fortra Conference for this one and the one coming in the fall as well.
Yeah. So for those of you who've been to our conferences, you guys know we do 2 a year, right? And we swapped them a couple years ago. So now we're going with our Vegas event going to be in the springtime. So at the end of the month, March 30th to 31st, we're going to be at the Cosmopolitan Hotel in Las Vegas for 2 days of private lending, networking, and education. We're really excited this year because we're going back to the Cosmo where we first started this show in Vegas. And this will likely be, don't quote me on this, but we're really looking towards other venues because Las Vegas is getting a little stale. But we also have another show coming up in the summertime in beautiful Newport Beach, right, Fashion Island. And that's going to be in August, August 25th to the 26th at the Bea Hotel in Newport Beach. That's a great, great venue. You're right there in Newport Beach, right there in Fashion Island. The beach is, 5 minutes away. We got multiple great golf courses. So it's becoming actually more popular than our Las Vegas show, actually. And both of them are multiple days, but lots of education, lots of networking, and all the top players in our industry show up. We've gone out of our way this year for our Vegas show. I've invited a few real estate clients of mine on the fund formation world to come speak to y'all, so you guys can learn from a borrower's perspective. And these guys do a lot of volume and are high value targets by a lot of the big shops. And so I hope you guys are nice to them. But it's a very, very good show, I think. And Ruby and her team have really, really worked hard this year. So if you haven't signed up just yet, please sign up.
What about the numbers? How many people have you gotten to come out to the last two?
Yeah. So I think in Vegas, we're expecting close to about, I think the usual number we're shooting for is around
500.
500, not 500. And then, Newport Beach, it's hard to say. We're always shooting for about 500. That's kind of the usual sweet spot. But Newport Beach is shaping up to be a very, very good show. So I think either way, you're gonna be in a room with a lot of networking opportunities. But both events we target right around 5.
And you get, if you've been doing your conferences for several years now, you get a lot of new entrants coming in and attending them. You have some veteran lenders that attend. From your repeat attendees, what do you hear from them as far as what they like about the conference and what value they get out of it?
Yeah, well, the number one thing I think is they get a lot of value out of is just the quality of the execution of the event, right? It's a very well put on event. Ruby is a seasoned veteran and a pro at doing this, and I think she puts on a fantastic event, very well run, right? Very well organized. And the content is very intentionally curated. We don't do pay for play, right? So we are doing this intentionally to serve your interests as lenders. So we are very cognizant of how to put together the best panels possible. So the content is typically something that we're very proud of. We get a lot of high marks on. And the other thing I would say is just the quality of the networking, because the two perspectives, right? The first perspective is going to be who's in the room, right? So we're fortunate enough to have relationships throughout the industry and throughout the country where it's valuable for everybody. On the flip side, because of our footprint, we're able to bring in new lenders, new sponsors, and in this situation, some borrowers, and that's been valuable to a lot of our clients as well. So I think that's a very important. We're always asking, how can we do better, and we're always trying to make it improve slowly but surely. That goes to even swapping the dates, right? We a lot of folks are having trouble with Vegas in the summer, so we swap the dates, right? So. And we're always trying to make it better for our audience and want to make everyone walk away knowing that they time well spent, right, away from their business, away from their families, and that's what means a lot to us.
And for anyone who's curious, tell us about the layout. You have one room that's the exhibit hall, and then are you doing just one session at a time in a speaking hall?
Yeah, and it goes back to the idea of content curation, right? So. We tried the multiple tracks route. It's just not a fit. When you do a huge event like APL, right? When you're doing 1,000 people, 1,200 people, APL has multiple tracks, and that works, right? Because you have different. But in our industry, at our shows, it's about 500, 600 people at most. And what we found was the common threads are always going to be. We're going to get a lot of questions over the years of doing work, right? And there's going to be common threads that we're seeing that need to be addressed. And it's good for everybody. And so we're trying to keep it really straightforward as well. And also because we're not doing kind of pay for play sponsor speaking kind of arrangement. We're inviting the speakers. Like we're literally like Nima, myself, Ruby. We're figuring out the panels, who will be a good fit, and we're asking people to speak. And so that has a lot to do there too, right? So that leads us to typically doing one track of panels. We added an extra day for education because a lot of folks who are smaller want more actual education, and so we're doing a lot of that on the day before the main day, before the welcome reception. That's how we do our events. Yeah. And for our new attendees, we typically go out of our way to make sure that we do a pre-conference Zoom meeting to help them navigate the event and make sure that, okay, here's who I should go talk to if I need anything. Here's what I can expect to be in the exhibit room, and they can communicate to us, this is what I'm looking for. And then we can pre-introduce them before the show.
Nice. And so you mentioned earlier that you're exploring alternatives to Las Vegas. We don't want to have you spill any secrets here, but just if you could just tell us, are you planning to stick to the Western U.S. for both of your conferences?
Hard to say. Yeah, it's hard to say. I mean, at one point, someone even mentioned like, other countries, and I was just like, well, no, that's just not possible. It's too much work, right? But I think right now we're still in the exploratory phase. We've been contemplating, the Southeast in Florida. We did an event in Florida many moons ago. It's relatively easy to pull one off. Miami makes it really easy on people to do an event there. Scottsdale is a very popular venue, but we've also been entertaining other venues like, someone brought up Chicago, right? Someone brought up Utah. So like, we haven't landed that plane yet. It's very challenging for us to just do it like that because we want to make sure that it's a good location, and we do not want there to be challenges to getting there. So we have to make sure that, okay, are there flights from the various locations direct? Is it the airport easy to get to? Is the hotel big enough? Is do they have enough room for our guests in the hotel? That's going to be, all these factors play into it. So it takes a little bit longer for us to do things, but when we do them, usually it's a good venue, right? So.
Yeah, definitely. Yeah, you have to make it convenient for people to fly in, and I think there's select locations around the country that cater to that, like Dallas. Denver's an interesting one because it's such a major hub and airport, but it's a small market lending wise, right?
We thought I nixed Denver for that reason. I'm not a huge, it's cool, but I feel like people would just kind of run away and go ski all day, so.
Yeah, I don't know. I always liked Texas as kind of a central, location within the United States that everyone can fly to. I'm not Austin because they don't have enough flights, but maybe Dallas, it could be a good location that's very central.
I've done a couple of events in other conferences in Dallas, and I really like the city from a conference standpoint. There's a lot of good hotels that are big enough, and it's easy to get to. That's really important. And you can do a lot of business while you're there, right? So it's important too.
Yeah, and there's tons of people that can drive there, right? If you're in any of the big Texas metro areas, it's all a 3-hour drive, maybe 4-hour drive for a lot of people. So, but on the other hand, I love Scottsdale. That's one of my favorite locations. But
it is for me as well. The golf there is just unparalleled, and I love the golf, so it's a good place to be.
Yeah. Okay. All right. Well, we'll be bugging you to keep us posted.
We'll announce it. Ruby will make sure to make it public and let everyone know. But we're exploring different locations for next year. But know that Newport Beach will be on the calendar, and it's already all scheduled. And I think that this March is our biggest show, and August is going to be Newport, and we're really looking forward to both.
Okay. And just to recap, the Vegas conference is going to be March 30 and 31. And then the Newport Beach conference is going to be in late August, right?
August 25th to 26th.
Excellent. All right, Kevin, that's all I had on my list for today. Thanks for taking the time for this, and look forward to seeing you at your conference in a couple weeks.
Yeah, man. It'll be great to see you again. Thanks for having me on the show.
All right. Thanks, Kevin. Take care. And that's a wrap for this episode. Fortra Law is listed on the services section of privatelenderlink.com. I put a link to their profile in the description. Kevin Kim is a securities attorney, and his specialty is private mortgage funds. His firm, Fortra Law, is 100% focused on private mortgage lending, They have a variety of practices to serve all aspects of the business for private lenders. Kevin also hosts a podcast called Lender Lounge with Kevin Kim, which was an inspiration for me to start the Private Lending Insights podcast. I'm a big fan of his podcast and highly encourage you to check it out. I hope the content of our conversation was valuable to you. Thank you for tuning in and listening all the way to the end.